So here's our first example. A dependent filer means that somebody is claiming this person on their tax return. And you can see here that it would have to be a qualifying child because his gross income is way over the $3,900. The salary is what we're calling the earned income. That can cause your standard deduction to be larger than $1,000. Taxable interest is what we call the unearned income or investment income. And anything over $2,000 will be taxed at mom's highest marginal tax rate. So here we are, the AGI, calculation for taxable income. The AGI is just AGI, no change there, no personal exemption. The standard deduction is more than $1,000 because there's salary. The salary did not get to the full $6,100, so you get to add $350 to wipe out part of the tax on that taxable interest. All right, if this tax calculation rule did not exist, you would simply take the taxable income, you'd look it up in the table, and you'd find that $473 is the tax bite. Unfortunately, this is a qualifying child, and so we land up having to use the kiddie tax rules. So first of all, how much unearned income will be taxed at mom's rates? Anything in excess of $3,000. The rest of taxable income, $4,700 minus the $3,000, is taxed at junior's rates. And so the total taxable income is $4,700 being taxed at mom's rates, and then the rest being taxed at junior's rates. So the marginal tax rate of the parent, I can either give it to you, or I can tell you the parent's taxable income, and you can go to your rate schedules and look it up. Or, as you'll see in our last example, you can use the handy-dandy IRS method. So here we are. The tax on the $3,000 is 39.6%. The rest of it, we're just looking up in the tax tables. And as you can see, the tax is almost tripled what it would have been if this rule doesn't apply. So $1,300 and change is still pretty small, but what this does is it generates some revenue, and it gives your congressman the right to go back and say, see, we are plugging loopholes that rich people's children have to pay taxes at a higher rate because we're not allowing their parents to avoid taxation by shifting monies to the children. Therefore, you should file your tax return. Right? Remember, our tax system is voluntary in the sense that they have to find you if you don't file your tax return. So the IRS and Congress want to do everything they can to encourage you to file your own tax return. So the purpose of this example is to investigate what happens if there is no earned income. So here the person being claimed has only taxable interest, and so the standard deduction will only be $1,000. No way to get over $1,000 unless you're old or blind or have salary. So this just repeats our calculations. The tax would have been $833, going to the tables, tax rate 10%. Got to use the kiddie tax. This time the unearned income is substantially more than we had before. And this time I have taxable income correct, $8,300 from the prior slide, minus the amount taxed at mom's rates, and I have $1,000 left. And so total taxable income has been accounted for. This time the parent's marginal tax rate is only 28%. So here's our tax calculation. The amount taxed at mom's rates times 28% plus the tax from the tax table for $1,000 for a single filer. And as you can see, this time, once again, close to about 3 times, a little under 3 times, the amount that would have applied if there had been no kiddie tax. One more calculation, see what our facts are. This time we have salary and taxable interest, but our salary is higher than the basic standard deduction for a single person, so I'm not going to be able to offset any of my taxable interest to even it out. So here we go. My standard deduction can never be larger than $6,100, so now my taxable income is $9,500. And now we repeat the tax calculations. This is what you get if you look it up in the tables. Note that now part of it is taxed at 10%, part at 15%. The kiddie tax, we start out with $7,000 being taxed at mom and dad's rates, the rest being taxed at junior's rates, and we've accounted for all of the taxable income. Marginal tax rate 33% this time. Tax calculations exactly the same as they were before. And you can come back and run through this math again if you feel so inclined. One more example before we start looking at the IRS forms. What's different this time? Notice it says standard deduction add-on. So we're still going to have a qualifying child, so our qualifying child must be legally blind. So we're going to take the income. We're going to do exactly what we did in the prior example, which is limit our normal standard deduction to $1,000 because there is no earned income. But the total standard deduction we're going to use is the sum of that $1,000 plus the 2013 bump for blindness, which happens to be $1,500. Remember, use the normal rule first and then add more. Right? Don't combine the two in one step or you could land up with the wrong answer. And the usual suspects. Here's the tax from the tables. Here, the kiddie tax rules. Because so much is being offset, taxable income is actually smaller than the 9,600 minus 2,000. And so no more than taxable income will be taxed. So all of the income is going to be taxed at mom's rates. But it's only 7,200 instead of 76 because that bump for being blind offset some of the income that would have been taxed at mom's rates. You never tax more than taxable income. So this time it's simply the 35% plus 0 because there's nothing left to be taxed at the kids' rates. So now we're going to deal with qualified dividends. Remember that the rate that your qualified dividends are taxed at depends upon your filing status. They could have written this rule to say that all the dividends are taxed at mom's highest marginal tax rate, and you would have been much happier than you are, because what's going to happen is we have a worksheet. We're going to separate out those qualified dividends between what is going to get taxed at mom's rates and what gets taxed at junior's rates. Junior, in our examples, will not leave the 15% tax bracket, which means that junior will have a 0 tax rate on his dividends versus the 15% for people in the middle brackets and 20% for the people at the top end. So the example we're going to do is a little simpler than the tax return 5. You're going to have some salary and some other things to make it a tad more complicated, but the actual tax calculation will be very similar to what we're doing here. So there is no salary. Now there's 2 kinds of unearned or investment income, and one of them happens to be those pesky qualified dividends. So the first step is to calculate taxable income the same way, no wages. So the standard deduction is the $1,000, and we're going to have to account for a tax on $5,300. Some of it is coming from those dividends, and we'll get the special tax rates. The rest of it is coming from the taxable interest, and will be taxed at mom's highest marginal tax rate. What's left to junior will get taxed at junior's starting 10% rate. So let's get going. First thing to note is we're going to use an IRS form called the 8615. The IRS has spent a lot of time trying to make sure that rather than try to teach people how the rules work, if they can just get people to read, then they can simply say, go from step 1 to step 2 to step 3. So here we're basically doing the same thing that we did on the PowerPoint slides with our free form examples. We are determining how much of the taxable income is going to be taxed at mom's rates. So line 1 is all the unearned income. Line 2 is that $2,000. So $4,300, combination of qualified dividends and interest, is going to be taxed at mom's rates. And then there's always that check back, just in case the kid's income is actually smaller. Remember the example with the kid that got the extra standard deduction? The actual income was less than the line 3 amount, and so the tax is only on taxable income. So this tells us that we are going to take $4,300 and we're going to do a tax calculation. So let's move to the next step. Part 2 of the 8615 does the actual tax calculation, but before we get there, we want to use this worksheet to figure out how much of the qualified dividends will be taxed at the parent's rate and how much at the child's rate. So note that lines 2, 5, and 7 relate to capital gains. They work exactly the same way. The tax rates on net capital gains are the same as qualified dividends, but we're not going to deal with that issue until we get to the end of the semester. So go ahead and put a squiggly through those lines if you want, so that you know that you don't have to worry about them. Right? So line 1 is the qualified dividends. Line 3 is the total unearned income. And we're simply going to calculate a ratio. 63% of the unearned income relates to the qualified dividends. So what we're doing on line 6 is, see, it says multiply 2,000. The 2,000 is the amount of the unearned income that gets protected from the parents' rates. So we're simply saying how much of that $2,000 are we going to call dividends that will get the kids 0 rate? And the answer is the 1202. So what is line 8? Well, line 8 is how much of the $3,800 is left. What does it say? Subtract line 6 from line 1. And so of the $3,800, 1206 will be taxed at the kids' rates. The rest will be taxed at mom's rates. So here is our breakdown. The $3,800, the amount that is on line 8 is the amount that you will use when calculating the amount of the child's tax at the parents' rates. And these parents are in the middle bracket, so that'll be 15%. And then you're going to have a separate calculation where you are going to figure out what is left, what is left is taxed at. And that answer will include up to 1206 that has a 0 tax rate, because the child in question here will be under the 15% marginal tax rate, and so the dividends get a 0 rate. So those parentheses refer to the rate at which the dividends are taxed, not at the marginal tax rates, just in case I did not make that clear. All right, so here's part 2. Before we get there, in this case, the parents are filing head of household. So what this form is doing is saying, rather than talk to you about all that stuff we did in the earlier slides, we're simply going to calculate taxable income of the parents with the kid and taxable income without the kid, and we're going to take the difference. All right, so line, let's see, go closer. Line 6 is the original taxable income of the parents, and then line 10 is the actual tax the parents would pay. So line 8 is going to be the taxable income plus, I think it was $4,300 that's being of the kids' income being taxed at the parents' rates. All right, and so we got a box coming up for where the 19,698 comes from. And so for the moment, just take the number for granted. Line 11 is simply the difference between tax with and tax without the kid's income, incorporating the special tax rates on the qualified dividends. And then you use line 7 and 12A and 12B if there's more than one child. All right, we'll talk about this briefly in class. If there are 3 or 4 children, you could be crossing marginal tax rates. You can't pick your favorite child to get the 33% rate and your less favored children get the 35% marginal tax rate. So instead, you're simply going to do another ratio. If that difference on line 11, if 30% of it relates to the taxpayer that you're doing the return for, then 30% of the 814 would be what you included on this particular child's tax return. So here's our tax calculation. All right, and you will want to do exactly this on tax return 5. And remember that I'm grading tax return 5. So it's important that you get this right. You want to rack up all the points you can. So we've done this before. The only thing that's different here is that instead of the whole $3,800, the qualified dividends are just the ones from the worksheet that have mom's highest tax rate. So that's 2,594. So we take off the qualified dividends and note that ordinary income has dropped below 100,000. I expect you to use the tables if taxable income is under 100,000. If you do not yet have your Pub 17, you can access tax tables as well as tax rates at irs.gov. I have a few 1040 or Pub 17s in my office that are left over. If you come to my office, first come, first serve, you can have one of those because they're just going in the recycle bin. And then that 389 is simply 15% of the qualified dividends, the 2,594, and then we add them up together. Right? So the process itself is no different than you have been doing since the first class. The only complication here is you have to use the worksheet to figure out how much of the qualified dividends are being allocated to mom and dad's higher marginal tax rate and higher qualified dividend tax rate. So then we have to figure out what was left to be taxed at the kids' rates. And there's only $1,000 of taxable income left. There was $6,300 in total. 1,000 got offset with standard deduction. And so there's only 1,000 left to be taxed at the kids' rates. The government is very generous here. They take the position that the most expensive, the income that would have been taxed at your highest marginal tax rate is deemed to be the qualified dividends first. So in this particular case, this child's share of the qualified dividends was $1,206, but there's only $1,000 left to be taxed. And so your line 15 amount in this example is zero because the whole $1,000 is deemed to have come from qualified dividends. And then so line 16 is just the 814 and the 0. Line 17 is another check back because it could be that the kid is actually richer than the mom. Because remember, you could make $1 million, but if you didn't spend more than half of your own support, you can still and will be claimed on your parents' tax return. So this check back, make sure you know where this calculation is coming from. Right? We're taking the original taxable income, and then $3,800 of that is the qualified dividend. It's being taxed at a zero rate, and so it's only the remaining taxable income that's being taxed at the 10% rate, and that's why the tax is $151. So make sure you can do that. Right? You go back to taxable income, subtract out the $3,800, assess it at a zero tax rate, and then go to the tables to look up what's left.